Hello guys, this is Trader Rob. So welcome to the second part of the mentorship option part 2. So today we're going to cover a lot of more details into really how to use the option. So last week, I covered the basic of it, what are the different strikes and calls, puts, and how does the premium is, calculated, the Black-Scholes model, the Greeks and everything. So first, let me just do a quick recap, so this way, hopefully everything is, clicking for you guys. And if you don't understand anything, feel free to ask questions because, if you don't ask question, I don't know what else I should be providing you because only you can tell me which part I made it clear and which one you need me to clarify a little more. All right, so the main thing is literally 80 or 90% of the things that you're going to be doing in options trading is going to be calls and put. Calls mean that you are long the stock, meaning that you want the stock to actually go up, and puts mean that you want the stock to actually go down. So it's almost the same thing as you shorting the stock. So the good thing about using option is you limit your risk. So for example, you want to short Tesla, at let's see, let's take a look at Tesla real quick. And Tesla is a little expensive one. So let me bring this chart. So let's say you want to short Tesla, and I believe the Tesla has an earning in the next couple of days, and right now Tesla is at $725. So you expecting Tesla to go down. You want to short Tesla. You think, you know what, Elon Musk is a fraud and the company's going to go down. And all the hype is just not true. Apparently, a lot of people believe that. I mean, I personally don't care, whether which way the stock is going to move. And a lot of people are really very, very bearish on it, while the big guys are actually very bullish on it. That the reason why the stock prices actually keep going up. I actually know a lot of people who have lost a lot of money on this one. So, for example, you want to short Tesla at $725 and you want to limit your risk. Meaning that if you really short, let's say 100 shares of that, you're literally putting up $72,500 for that and you're shorting for this price. And I don't know, some broker may be charging you shorting fees and all other kind of stuff. So just think about this. So 72,500 is costing you of buying power to short the stock. Actually, it's less because broker calculate differently when you're shorting it or whatever. But just think about this: $72,000 is a short. This is if this actually goes up to, let's say the earnings were actually good and they come up with good news, who know, even like the ventilators, they made like a lot of ventilator and they actually selling to the US government and they actually making, they're selling for like what 25,000 or whatever and they actually making 10,000 profit on each one of them, and now they're going to be selling to the US government, they're going to be selling to other countries or whatever, you know, weird news, whether it's regarding the ventilator, it's regarding the cars or factory, whatever it might be, you never know what's going to happen with the earning. And let's just say this stock goes up to $1,000. So right away, now you're going to be losing $27,500 on that 100 shares because you shorted at $725 and now the price is 1,000. So you're actually losing 27,500 on that position. That's your risk. And if it goes higher, you can lose actually more. So option allow you to minimize your risk. So look at over here. So we expecting this thing to price to drop. So we can buy this thing for $5,000. So this is around what, $49.25. That was the last it was traded. So that's $4,900 and 49 and $25. So for less than $5,000, we can actually make that bet that the price is actually going to go down. As long as the price goes below $675, you will make money. If the price of this thing stays below, I mean, 675, you will be in profit. If it stays above that, you're going to be losing money depending on where it is. If it's over 725, you're going to lose all the premium that you paid. But literally on the good end side, if it goes to $1,000, you only lose whatever the premium you actually paid for it. You do not lose anything more than what you just paid for it. And if it goes down to $300, well, guess what? You just made a difference between 725 and $300. So that's 425. 425 multiplied by 100 shares because each contract is worth 100 shares. So you just made $42,000 and 500. No, what is it? Somewhere. Yeah, 42,500 you made on one contract, and you only risk $5,000. So from $5,000, you made $42,000. So it did the same job as shorting 100 shares, but you limit your risk. You're only responsible for whatever you paid. Now, if you were selling it, now that's a different story, because when you're selling it, now you open up yourself for more risk, just like selling a stock, shorting the stock. But over here, when you're selling option, it works the opposite way. So for example, if I'm selling a call, that means I'm actually bearish on the stock because if the so let's see, but it works better by selling options rather than just selling regular or shorting irregular. So the smart money when you think about it, like shorting it. So if I want to short Tesla because I'm bearish on that, rather than buying put, put is good, but you can see the premium is pretty expensive. I can also think to myself that like, hey, listen, you know what? I don't think so this stock is really gonna go up that much. I'm expecting it to go down. Actually, why is it showing up? Give me 1 second. Feel like it's not showing me the whole thing over here. The bid and the ask. Yeah, I feel like the bid and the ask is not showing on me over here. Anyway, I can work without that. So back to the whole thing. If I wanna short stocks, rather than really just shorting the stock at 725, I can actually use the option and short the share through the options. Sometimes it works, sometimes it doesn't work, but it does definitely lower your costs. So for example, I say, you know what, rather than shorting at 725, I think even if they have a decent earning, maybe the price doesn't move around or whatever, or I'm okay shorting this stock at 750, even though right now it's 725. I can sell calls for $750 calls contract to somebody else and I could collect $3,900. That is lowering my cost by another $3,900. So literally what I'm being short is at 389. As long as the price by May 1st doesn't go up more than $750, I will be able to keep all that money. And if the price goes up, well, you know what? I'm only going to be losing money when it goes over 789 and I will be assigned short position. So to me, this is a little bit better way shorting stock by selling options on the call side. So this way you get collect some premium and you can even go further out of the money. So rather than, if I want to do it at 725, I'll collect the $4,900. So this way, I'm being short at almost what is it? 774. That's what I'm being short at. So this is one way you can do it. So just remember, when you're buying call option, you're long. When you're selling call option, you're short. And same thing for the other way. If you're buying puts, you're short. And if you're selling put, you're actually long. You're thinking the price is actually going to go up on the stock. That's why you're selling the puts. I know it's a little confusing. You'll get through it, like you can you can see a couple of times and practice it. It does take a little bit of time, and you also have to train yourself. But just remember, if you get that thing like buying calls is long, you want the stock to go up, and if you're selling, it's always the opposite. That's an easier way to remember that. All right. Strike. Strike is like, the most, a lot of people get confused about like which strike to choose because there's so many different options. So let me go back to it. Strike is you pick whatever strike you think is good, like the blue area right here on the top, that's in the money. This is at the money. And everything like right here, the black is out of the money. So if you want to capture the big move, you want to get at least at the money. If you're thinking the move is going to be really big, you think, it's going to go up like, let's say, $850 or whatever, that you want to go further out of the money. The bigger the move, the little bit out of the money you want to go because you're going to capture more and you would be able to buy more contract with your money. And remember, delta is what telling you the percentage chance what the market makers are expecting of this strike being in the money. So over here at 735, it has 50% chances of being in the money. This is the expectation. So just remember that market maker know the market a little better than most people, and they have priced in what the stock is going to do before, and they're placing the premium according to that. So it's almost like a zero sum game where the market makers are going to collect enough money from everything, from the call side, the put side, to make up for the risk they are actually taking it. And they usually have better information to do all these things. They have all this historic data, and they have such a complicated system, which is pretty much, like dead on when they really calculate where everything should be. So if you do like take, let's say, 1,000 trades, you're pretty much going to be like zero sum game. It's not like you're going to be coming out, whether that's on the call side or the put side, you're pretty much going to be coming up at zero sum game. That's the way the stock market is designed, for you not to make money. The only way you're going to make the money is either if you have some insider information where you know for sure, or to make really, really smart bet where the market maker did not price in the contract correctly, where you can think the market makers are expecting the move to be only $50, but you think, what, based on the previous research or something that you're seeing or whatever, and what's going on with the market overall, that the real move is actually going to be bigger than that. That's going to be your edge. You don't want to take a trade just to take a trade. You want to take a trade because you think the market makers did not price that particular option correctly. And I'll go like a little more in detail, like, the way I actually do it. So this way you can see like a little bit, my way of doing it. All right. So, strike. So you can pick whichever strike. So let me give you another example. All right. So Apple is at 284, 283. Right now, the future market is moving up. I think the high this thing was over $300. Apple is a good company. I think Apple is going to do really well. So I say, what? Even though we going through with like a lot of COVID thing, the stock is really coming back better than any other company or whatever. So you know what? I say I want to buy this thing. Let's say um, June expiration. So you can pick each dates over here. The further you go out, the better it is for you when it comes to time decay, and plus better chances of you actually succeeding it, because if you're giving yourself enough time and the stock can go up, go down, or whatever, you have a higher chances of actually doing it. But the trade-off is you actually paying more in premium. So for example, you can see, let's say the strike of 290, I think the Apple is mispriced at this price right now. I think the real value of Apple should be, even this crazy market, is over $300, because Chinese are back to manufacturing everything and people love Apple. People are going to buy this new Apple iPhone, whatever iPhone they're coming out or whatever. So you're thinking that's your expectation, or Apple may be coming out with a new product or whatever. So you're thinking the real value is $300. So you can see right here that 290, if you want to buy it for this week, is around $4. But if you give yourself enough time, let's say June contract, 290 is actually worth around $12. So you can actually see right here, if you add those two, that's your break even point. So 290 plus $12, that's $302. So this is what the market maker are actually predicting as well, that this thing really should be worth around $302 by this time. If you look later on, you can see, let's say by January of next year, 290 calls are worth around $28. So the market makers are really predicting that this thing to be worth around $318, I believe. Around $318. This should be the value, but at that time. And if you think they are not priced correctly or whatever, that's where you will get the edge. Where if you think that, you know what, it's not going to be $312 by June, it's actually going to be like around 320 or 330 because everything is going away with COVID and things are going to be moving very quickly or whatever you may be your reasoning. So this is how you pick. So obviously you can see, even just like talking through, I'm not seeing a much edging over here where it gives me a clear point of view of like, you know what, I am expecting this things or whatever, and I think this is a good trade. So you can, by looking at Apple, anything is possible with Apple. I think Apple is a good company and it's going to move up pretty quickly, but the market makers have already priced that in. So if you're looking at 290, for this week, the market maker thinking that, yeah, there's a small possibility, 34% possibility, they can actually go up to 290. And also be careful whenever you're buying something of theta. Theta is a time decay. Every day the premium is going to be dying down by this amount. And as it get close to the expiration, this number theta will become higher and higher, and your premium is going to be getting killed very quickly. So let's say 290 right now at the market open. Let's say the stock does nothing, stays at the same price for this whole week. $4.05 premium is gonna be reduced by 58 cents one day. Then obviously the next day, whatever is gonna be getting reduced even more and more. This theater is gonna start going up. And let's say even like by Wednesday, this thing probably would have lost close to 40% of the value, and this thing maybe only worth like close to maybe like 220 to 240 or somewhere around that range. All right. So next one is expiration. We just covered that, and the power of the leverage. So the good thing about options is it gives you the leverage. Each contract is worth 100 shares. So let's say, for example, let me show you SPY. So SPY used to be one of the stock there. Me and a lot of the other admins and a lot of the other people in the chat room trades a lot because it's really used to be priced very well, where it's the most liquid stock and the options were beautiful. Where normally at the money you can really buy it for anywhere between 50 cents to 80 cents normally. So you're able to control 100 shares of the price or whatever it might be, let's say 282. So let me show you the power of the leverage. So let's say the price is 282 and you're able to control 100 shares. Normally it would cost you around $28,000. And so if you want to control 1,000 share of that, uh, it would cost you 282,000. What we were doing was we were able to do it for 60 cents per contract. Let's say even 70 cents. We were controlling for 70 cents multiplied by 100 because so each contract that we were buying for $70. And to control 1,000 shares, which rather than costing 288, it was only costing us 700. It was only costing us 700 to control $282,000 worth of stocks. And we were just going for a quick move. We were not going for like huge moves or whatever. We were just looking for a quick 5 cents. The SPY to move like 10, 15 cents so we can get over 5, 6 cents that we were looking for. And 5 cents time, let's say 10, you can see that 5 cents multiplied by 1,000 shares on just only 10 contracts that we were doing, and some of us were doing 50 to 100 contracts. So we were trading. Let me just do an exact example of that. So let's say we were buying for $70 each contract, and some of us were buying 50 contracts. So it was costing us, our buying power was $3,500 to control, you know, crazy amount of shares, and we were only going for 5 cents scalp. So we have 50 contracts, so that's 5,000 shares, and for 5 cents profit. So we were making $250 profit per scalp. And we were doing a bunch of them, in a day. We would probably like be done like Sticks, Captain, BBR, myself. We would be doing maybe like 10, maybe between 4 or 5 scalp to like 10 scalp in first hour or two. So you can see that each time we were scalping, we making $250, and we using the same $3,500 because we in and out of a couple of minutes, and that's the power of the leverage. You can control so much of that. Even like example of Tesla. Tesla is worth 750 multiplied by 100 share. That's $75,000. Or you can get the same control of the shares for $5,000, which is currently priced in very high because there's an earning this week. Normally that would be like maybe half the price or something like that. So we talked about the time decay, and also, there's two parts to most of the options. So there's an intrinsic value and time value. So let me show you that quickly. And let me pick Apple. You know what? Let me pick Tesla. So over here in the black, the easiest way is everything is a time value. There is no intrinsic value. So current price of the stock is $725. And if you're buying at $725, there's a 15 cents intrinsic value. Everything else is a time value after that. If you're buying at 720, you subtract the strike price from the actual price and you will get your time value by getting that, because first value is going to be, well, let me rephrase that. If you subtract your stock price with the strike price, with the strike price, you will get the intrinsic value. If you were to sell it, what exactly is the value that you can get out in the stock if you were to exercise those shares? So you can see stock is worth 725, so there's $5.15 value in that. All right, on to the next thing, and everything else is time value. So in this case, there is around, let's say, this price right here. So $5 is the intrinsic value and $48 is a time value. So obviously, the deeper you go in the money, there's going to be more intrinsic value and less time value because you're risking more of your capital. Now, a lot of you, don't want to risk so much money to buy one contracts of this thing, even though, some of you guys may be trading a small account or doing something differently. You don't want to spend $5,000 just to buy one share or something. So the easiest way you can do it is if you know the direction, or if you think certain things going to do. Let's say, let me rephrase that as well. If you think Apple is going to be going up in the next couple of weeks, so let's say May 15th, you think Apple is going to be going up, and you don't know what the price is going to be, by you thinking somewhere around, like, let's say $295 to $300. So the cheapest, and you don't want to pay anywhere these kind of money. You want to do it the cheapest way possible, and you want to get a good return on it. So here's a way you can do it. You can do something called vertical call. You buying one and you selling the next strike above that. What do I mean by that? So in this, we can buy 280 and we can sell 285. So or we can even do like, let's say 280, 280, 280, 250. And obviously, the more further you go out, the cheaper it's going to be. So for example, 280, we can come here, buy, we can click on vertical, and down below it will show us. And you can decide how many contracts you want to buy. So everything usually defaults to 10 contract, and you can change it manually to whatever you want. So you can see right here, Apple May 15th, 280 strike. You're buying the right to buy at 280, and over here you can see the negative sign, and you're selling 280 to 50. So there's a $2.50 total difference between those two things, and it's costing you $1.43. So you can check this thing right here. So you will be paying $143 to make $250. So your total profit would be only $107 because you're buying so close to it. But for $143, that's a nice return. So if you see $107 divided by 143, that's actually 74% profit. If you actually know that you're going to be right on the move, if you really think that the stock is going up, that's a good way to really place a bet because you're getting a very high percentage and you're getting it in a shorter period of time. And it doesn't make a difference if the stock is over 300 or whatever. As long as it's over 282.50, you will make money. And your break even in this case would be 280 plus 143, what you paid for it. Actually, 280 plus 143. What am I doing right or wrong? All right, one more time. It's late at night. 280 plus $143 that you paid. So as long as the stock price is 281.43, you will actually make money on this thing. As long as it's above that, you will make money. As long as the price is this, you will break even. Anything below that, that's where you're going to lose money. So this is the quickest and easier way for you to make small bets on a directional of the stock that you actually think is going to be happening. So let me show you another thing that very well could happen tomorrow. So you can see, let me open up future real quick. So you can actually see the futures right now. It's actually moving up. So if I were to translate that into S&P, right now it's close to 284, 283 to 284 price on the SPY. Right now so right now, if the market open up where it is on the future tomorrow morning, the price is going to be 284. And I believe that, you know what, tomorrow we're going to get the bad news that there's over 1 million coronavirus cases in the US and things are still looking pretty doomy and everything. And I want to make a directional bet where I think, you know what, this move up was just stupid on the Friday, and today I can do this thing. I can buy a vertical put, and I can just buy $2.80 puts. Right now it's showing for around $1, and by tomorrow open it's going to be actually cheaper since the price actually move up, and the puts are actually moving out of the money. So this thing probably could be worth like 80 cents or whatever it might be. So if I were to, let's just say this is where the market is opening right now, I can actually just buy this thing for $104 and wait until, let's say, the price closes at 277. I would make close to $3 total on this thing minus the $1 I paid. So I would be making $200 profit. This is like almost like 200% profit on this thing. So 300% move. Or you can do something quick like this, where you can say buy a vertical, and you can see at the bottom right here, I'm buying the puts. I'm buying 280 and I'm selling 279. So I personally don't care if it goes down to 277 or 275 or whatever, as long as I strongly believe that it's going to go below 279. I can actually take this bet, and This is, I only have to pay 23 cents on that. So literally, I only have to pay 23 cents and I can make actually $77. So you can see right here, minus. So I can actually make $77 on $23. So let's see, how does that, the math work out on that? Um, Actually, I'm doing something wrong. So $77 profit on 23. So you would actually be making close to 334% on that move rather than just buying it naked, where you're just thinking that as long as it moves to 277, you're making 300%. On this thing, you would actually make a bigger percentage move where you can buy 5 contracts, 10 contracts, or whatever you want, as long as this stays below 280 or below 279. And you can do the same thing right here, where you don't know if it's going to do even to 280, but you definitely think it's going to, maybe do at 282 or whatever. So you can come right here, try this vertical, and you can see right here. So close to the money is almost like a 50-50% bet, and that's what you're doing. You're risking $52 to make 48 cents. Sometimes you can play, you can get a little bit of pricing by a couple of cents. So that's a quicker way for you to make 100% profit. You don't have to make, and this could be 100% profit in one day, because this is on SPY. The contracts are expiring 3 times in a week. You can see that 27 is a Monday, 29 is a Wednesday, and May 1st is a Friday. So that's 3 times you get an opportunity to do it. But remember, what I talked about the theta, theta and time decay, it's crazy. It's, you can see right there, like, you know, this thing is going to be worthless. The whole premium that you're paying, unless it's expiring in the money, everything is going to be time decay. So everything that you're seeing right here is going to be lost in a time decay, and theta is just going to be moving up crazy. Because if it closes at, let's say, 283, everything below that is just worthless. And even at 283, even this thing is worthless. The $2 premium that you're paying in the morning is worthless, because at that time you selling the right, I mean, you bought the right to sell it at 283. If it's at 283 and you paid $200 for it, you just lost that $200, because you paid that $200 expecting that the move was going to be bigger than $2 on the downside. So when you're buying this thing at $282, I mean $283, you're expecting that the end of the day, the pricing for this stock is going to be below 281. That's where you're going to make money. That's what your expectation is. If your expectation is you're going to make the stock is going to be at 277, then this is a very smart move. Buying anywhere around here is a smart move. So the market maker, you can see the market makers are collecting premium over here from all these people. Market makers are collecting premium from all the people over here. So this way, it doesn't really make a difference which direction it happens. They collected more premium in than what they're going to pay out like an insurance company. All right. So vertical spread. So now there's another something called open interest. So personally, you don't want to be the only person in a trade. You want other people to be in a trade. And I have a custom script over here, but it tells me the net change in open interest. And I think you can put open interest over here somewhere as well. Open interest, you can see that you can put it right here. Where is it? So open interest right here, I can apply. Now, this is a very important. This shows me you. This shows me and you and everybody else how many contracts are there. And a lot of times these work like a magnet, because sometimes the big institutional buyers, they usually know something and they're placing a heavy bet on that. And a lot of times this works like a magnet toward that. So we can see that right here. Based on Friday, the expectation for the stocks to is the heaviest over here at 288. that the SPY could actually reach 288. Doesn't mean that it's going to happen, but that's just an expectation. You can see on the put side, not as much as bad as the bet over here. Then you can even see the next day over here, 285 is expectation right here, and heavy bets on there, and not so much on the put sides over here. So you can see how the big investors or a lot of the people are expecting this thing to go up. Now you can look at Tesla, which I believe the expectation, since this is an earning, is going to be on both sides. So you can see, you know, some people are expecting to go to over 750, and there's a bigger bet on 695. And obviously I can change this thing to show me all. And you can see, I don't feel like scrolling, but the easiest way I'll show you is, if you really want to do it, you can just go to Yahoo Finance. You can put whichever symbol that you want. You can go to options. And you can go right here. Like you can see everything right here. Open interest. And obviously everything in the dark, as we spoke about it, in the money, at the money, out of the money. So you can see where is the heavy bet. The first obviously on the top is the top side over here, or the left side in majority of the trading software is usually the call. So you can see, some bets over here, some bets over here at 800, there's some even bets at 900, decent open interest. And now looking on the put side. So right here, this is for May 1st. It tells you the expiration. So let's see. So you can see the expectation. Some people are expecting it to be below 710, 700, 650. Right here, even 600, 500. So, this is just showing you the expectation of people and people that actually have put their money there. And this actually shows you exactly what they are, though. So you don't want to be in a trade where you're not seeing much open interest, especially if you're swinging stuff. And I'll show you a couple of examples in a few minutes for that. All right, so here's another question. When do you buy options? You buy options when the premium is not too expensive, and you buy them when things are looking, you actually think the market maker are not pricing in their option value correctly. You think your expectation is different than the market expectation, because the market expectation you can easily figure out what they are, because you can go to the break even price for whatever it is. Let's say Google. So you can know what the market expectation is for each stock or whatever when you just add up the strike price with the premium. That's what the market expectation is. All right, you know what, this could really happen. So over here this week, it could go up to like $32, so it could be really worth like around $310, or it could really go down $42 or $40, so it can actually be like around 1240. You can go to the different strike price and calculate that, but usually at the money, is usually a good place to see the range of the stock where it could really be for this week. And obviously you can do that for the next week as well. But if you think your expectation based on whatever your research is or based on the technical analysis is different, that's the time when you actually buy option, because you don't want to be getting caught paying a lot of premium and time decaying and working against you. Because at that point, if the stock is staying within the same range, you're actually losing money. And there's strategies around that as well. That's called like, straddle. You can do like sell, you can buy if you think the expected move is higher than this thing based on the earning, you can buy the both side, the calls and the put, and you might be paying like, let's say 70, what what is it? Let me calculate that correctly. $7,600 there and $4,000 right there. So let's just say $7,600. So you're paying $7,600, but your expectation is that this is going to move by more than $100. So you think you're gonna make over $10,000, but you're paying $3,600, so you will still make $2,400. It doesn't make a difference which direction it moves. You will make money as long as it moves $100 or whatever. And you can do the same thing on the opposite end, which we do a lot of it because we don't play earning. So this is like one of the strategies that we use a lot. So for earning, we don't know what's going to happen. We take the market expectation or whatever the market expectation is, just like I showed you, if you look at the money or whatever, and we go that much out and we actually sell the premium for it. So we can sell this thing right here if we don't think that the market is going to really move more than $7,600. We can sell the straddle. It costs a lot of money, but we do a lot of iron condor. So we can go, if the expectation is, let's say 70, so we can go, this one I'm not correctly set up, but over here I can go sell $1,210 calls, I mean $1,210 puts, and I can sell almost like $1,350 calls, and I can buy another layer as a protection on top of that on the both side to limit my losses just in case I'm wrong. And let me show you. I think you can do this thing right here. You can click sell, you can click iron condor, and you can see that there's two calls. One calls you buy, one call you're selling it, the other one you buying it, and same thing for the put. You're selling a put, and then you can adjust it. So based on what I was telling you, this is the call side. So let's say expectation for this week is that it's going to stay within this range. And yeah, I want to protect myself, give like a $10 range. And 1280, so 1210. So you can do this thing regarding when there's an earning or without that, but obviously this market is very news driven and anything is possible. In a stable market, this works a little bit better, but even this kind of crazy market, the premium is very high, so it may work well as well. So 1200 for that. So over here you can tell, I think it's going to stay below 1350, and I'm buying my protection at 1360 just in case I'm wrong. I can only lose $10. And over here, I'm selling 1210 because I don't think it's going to go below 1210. I'm buying protection at 1200. And you can see right there. So each direction, I can lose a total of $10. But right here, I'm collecting $4 premium. So literally, I'm only going to lose if I'm wrong in just on one side because either the stock is at the expiration is going to be below or it's going to be above one certain price. So the risk is only $6 because I'm collecting $4.05 in premium. So as long as it stays within this range, I will actually make $400. If I'm wrong and it goes really beyond these levels or whatever, the most I can lose is $600 because it's a $10 range and I collected $4 already. So the most I can lose is $6. So it's almost like it's a 60-40 bet. And this is a lot better bet that pretty much I would take it any week because you know what? I'd rather collect $4 for $400 and risk $600 and have this huge range. So literally think about this right here. I have what? I'm 1350 to 1210. So I have a $140 range. If it stays within that range, I'm actually going to make money on the stock. And right now it's trading between 12.76. So this is a good way to play earning. That's what we do. Usually you have a very good high success ratio of that, 70, 80%. And even when you're wrong, you're not really wrong much. But obviously, anything is possible and there's no strategy that works 100%. But this is a good way we trade earning. We play on the both side. We collect enough premium to make us almost like 40-60 bet or 50-50 bet, where we okay with risking that much because we know more likely the chances are 70-80% or higher that we actually going to make that money. And again, we went over open interest, when to buy it. Now we're going to talk about a couple of the long-term couple of the strategies that we use. So one of them we just talked about is during the earning, we sell iron condor. That works like beautifully majority of the time, and even the times you get screwed, you don't get screwed that bad. That's why a lot of people love earning, like because that's the best time to actually sell premium. All right, strategies for long-term investors. So, selling naked puts and cover, I'll tell you go over in a few minutes. So let's say, I own a bunch of shares and everything. So um, let me give you an example of what I own. I actually own XLE. So XLE is an energy sector. I actually own that, and I have 100 shares of that. And I think right now the price is around $34, $35. And I actually sold cover calls against it to collect some premium because when you're selling cover calls, you're writing a contract where you giving your right to somebody else to sell your shares to them at that particular price, and you collecting the time value. So whenever you're selling a cover call, you always want to do it at a profit. You don't want to be doing deep in the money. You always want to do it out of the money. For example, at $36, I sold it when it was worth around $3,300. So I put a contract out to sell it at $36. So I'm okay right now. The price of the stock is 34.62. I'm okay selling my shares at a much higher price at a profit for $36. And when I'm selling that contract, I also collected that contract for $83. So literally, I'm selling those shares at $3,683. That's what's happening. And if by May 1st the price is below 36, I collect the $83 premium and I keep my shares. So this is a quick way for you guys if you do have big accounts and you're a long-term investor to get some additional yield or extra money from your stocks because you don't as you know the stock doesn't move in a straight upward direction. There's like always like hills, valleys, or whatever you want to call it, like they move up, they move down, or whatever. So selling cover calls where you feel comfortable selling a share, it's a good price to add some extra value to your portfolio and get a better performance. So example, Apple, let's say if you own 100 shares of Apple, and this only works if you own 100 shares because each contract is worth 100 shares. So for example, if you own 100 shares of Apple and you say, you know what, the current price is 283, I'm okay at selling at 295. That's $15 more than where the stocks are trading right now. That's 1,500, $1,300 more. So you know what? I'm okay if by May 1st I can sell my shares at 295. To do that, you selling your contract, writing this cover call, and you actually collecting $250 additional premium. So you're actually selling for almost like 297.50. And if you have it at 282, like there's no need to be greedy. Of course, long-term investors, they want to keep their stock for a long time. So when comes time May 1st, if the stock is below that, you keep the whole premium, you do nothing, and you write a new cover call for the next month. You can do it weekly, you can do it monthly, depending on whichever is your feel comfortable, how much time you want to spend in it, how closely do you monitor the market. If you just don't want to do a lot of headache, then you just write monthly calls against those because it gives you a lot of time and you're collecting a lot more premium. For example, over here, 295, you're collecting $485. So you're almost selling, if that happens, you're selling at around that price. And when let's say the price is around 297 by the expiration of May 15, what you can do is you can roll this, you can close this, you can buy back for whatever it's worth, and you can sell the next month, May, June. So you can sell June, which 295 over here you can see is worth more. So it's worth, if I subtract the May from June, it's worth another $400-$500. So you can always roll it up to the next month if you want to keep the shares. And if you're okay with selling it, that's such a high price when you bought it at 282 or even like lower, even more power to you because you made that money. Plus you collected the additional premium and that lower your costs because if the stock, let's say it doesn't hit there, if the stock actually goes down to let's say 260, well, guess what? It lower your cost because you collected over here 485, let's say $500. So you actually lower your costs rather than 282 if you bought it. It's only costing you 277 now. So you protect yourself on the downside when you write cover calls. The only time it really doesn't work is you were too correct on your stock and you were not correct on the timing when you sell it. So for example, I want to give a shout out to Mike P. He bought 100 shares of Amazon at $1,700. He did phenomenal. I mean, Amazon during this COVID COVID-19 thing just kept on running, and it's just crazy how much it ran up. So it just keep going up and ever. He was selling 2020 or $2,040 contracts, and he was making $3,000 to $4,000 collecting premiums from those per week. He was doing that, so he made like 15,000 or something selling those premium, and he captured that move from 1,700 to like 2,040 because his expectation was that yes, the stock is going to go up in the longer term, but it's not going up right away to 2,100 or 2,200 or whatever. And he was okay selling the shares at 2,040. So right now, obviously, his expectation of the stock going up was correct, but his timing was off on this thing where, you know, pretty much the majority of the people did not expect Amazon to be 2410. So he still has 2040 whatever. So obviously he can roll it to the next week or whatever because there's still demand and he can still collect premium. But there's a good chance that he may have to get rid of the price and he limit his up potential because he doesn't capture up any of the move above the call strike that he actually sold. So he doesn't get any money from 2040 to all the way up to 2410. So let me show you. 2410 is the current price and 2440 is his thing. So he doesn't get that $370 move per stock that he lost on that though. But at the same time, if this thing was going down, he would be very happy because he collected $3,000 to $4,000 premium every week for last almost like month and a half or 2 months. So it works wonders. The only time is you really get screwed is if your stock is really moving too much further up and your initial thing of holding the stock was correct, but you actually just missing out on the upside potential. Other than that, it really doesn't have a downside because if the stock stays around the same, You keep all the premium. The stock moves down, you keep all the premium, and at the same time, even if the stock goes up, you're still selling at a much higher price than where you currently are, and you're collecting the premium on top of that. So it's a good way. Now, on the other hand side, if you're a long-term investor, you want to buy some certain stocks. So there's a example that Warren Buffett, he wanted to buy Coca-Cola for a much higher price, and Coca-Cola would not sell it to him. At even at a premium, he was offering them, maybe 10, 20% higher than where the stock was trading. They would not sell it to him. What he started doing was he started writing puts, um, selling puts against the company, and eventually he collected a lot of money, and the stock actually came down, and he were assigned all those shares. So just remember, when you're buying put, you actually buying the right to sell the shares. And when you selling put, you actually buying the shares at that specific price if the if the if they are in the money. So meaning that if they are in the money, let's say around here 24.15, if you sold that thing, you promising somebody that you're going to buy their shares at 24.15. So in a Coca-Cola, whatever the example might be, so he actually got assigned those shares that people, he sold the puts to, and the stock actually came down. And even the Coca-Cola didn't want to sell him the shares. The open market just gave him all those shares because the stock actually went down. And in the meantime, while he was doing for the month or the year, in the meantime, when he was selling those put, he collected very nice premium on those shares. So it lowered his cost. So if you're a long-term investors, you want to buy shares of a company and you're patient, you can, let's say I want to buy Apple. I like Apple. I want to buy Apple at 250. I can't even spell Apple today. So let's say I want to buy Apple and I want to buy Apple at 250. This thing. So what I can do is I can sell Apple puts. If I sell for this week, I'm only going to collect $36 per contract. But obviously, you need to have enough money in your account to actually, do the sell the puts. Because if you're going to buy the shares, you need to have enough money in your account. So in the meantime, while you're being patient, you're actually collecting a very nice premium, almost like nice interest on your money if you want to think it that way. So if you buy on May 15th, if you just want to think about the monthly contract, if you want to be patient and you are like, you know what, I like Apple for long term, I want to own the stock for less next 5-10 years, 282, 283, I think it's a good price valuation for the company, but I want to buy it for cheaper. And the way to do it is you keep selling puts. You sell May 15 puts, you will collect close to $215 profit. I mean premium. All right. If the stock is below 250, you will be assigned the shares of 100 shares of Apple at $250, $250. If it's worth at 220, guess what? You're still buying them at 250 because this is a contract you sold to somebody else. You can, obviously you can go out in the open market buy for more for 220, but right now in the meantime, you getting this thing at 248 because of $2 premium that you paid. So your real cost is 248. Obviously, if you're holding this stock for 4 or 5 years and it goes up to $400 or $500, who care what price you bought at 220 or whatever. But as your expectation is, this stock is going to go up, and right now it's at 282, and you want to buy below 250. So this is one way you're going to be able to do it as long as you're patient. Whether we have a coronavirus or crash in the market or whatever, that would be a way for you to get assigned those shares. In the meantime, you just collect a nice premium on your money. Because let's see, to do a quick math on that, because the bank are not paying you that much money. So 100 shares of Apple, let me just see if I'm doing correctly. 250 times 100 shares is $25,000. On a $25,000 in less than a month, you're collecting what is it? $2.15 $2.15 divided by 50 times 100. You're collecting almost 0.86% yield in 1 month. And if you multiply that by 12, you're getting almost like 10% return. Just doing this strategy where you may be assigned the shares that you really want to get at a cheap price. If you get assigned and this thing starts to move back up like it did, you're golden. But this takes a lot of patience, and you miss sometime the move on the upside where in case if you think this thing is going to go up, it goes up to like $300 or whatever next week or whatever. You know what? You're going to miss out on that $18 move. But in the stock market, you never know what's going to happen, and this is a smart way to do it and collect a little bit premium. So in the longer run, this strategy will win compared to short term, unless you really know something where you expecting the moves to happen, where your expectation is different than the market. Then you can just buy straight calls. If you want to buy the shares for the long term, well, this is a good way to reduce your costs, because every time when you're selling it, you're reducing your cost by a couple of $100. you know when May you did it and there whatever, eventually you will be pretty much buying it for like nothing. And especially if it's during the, what's it called, the earning time is the best time. So let me see, when is the Apple earning? So Apple earning is actually April 30th. So let's look at Apple 30th. So you can see that right now you think during this, let's just say Apple is going to have a great earning, and you think they're going to go up to $300, then you can just go ahead and buy, obviously, calls for this thing at 280 or whatever. Let's just say even 285. You can buy the 285 calls, which is going to cost you $6. So your break-even cost is 285 plus 6. That's 291. And if it's going to go to $300, you're going to actually make $900 profit on that move. And if you want to be assigned the shares, then obviously you can go sell close to the money. If it's let's say 280, you can sell 280, and or even, let's say, you can even sell 290 if you think this thing is going to go up higher, and you have a very high conviction of that. You can sell 290 puts, and you can collect $1,130 premium. And as long as the stock is above that 290, you will make money, because you're going to keep all the premium. If the stock, let's say, is closes somewhere between 285 to 290, you still make money. You get assigned those shares for the long term, and you still made money because you collected more premium rather than just buying at 282 right now. Hopefully that makes sense. If you need more clarification, just reach out to me. But the way I like to do it is when I want to buy a long-term stock, I want to be patient, I will just sell puts, especially during the earn time. If I think, this stock is going to do good, I can just go sell, let's say, even 280 puts. I collect $600 premium. As long as it's over 280, it's going to do well. Where I'll keep the whole premium. If I get assigned the shares, I'm okay with it, because Apple is a good company that I like. I wouldn't mind holding it for a couple of months to a couple of years for it to come back up. But rather than buying at 283, guess what? By selling the put, I actually bought this thing at 274 at that point. So you can see how that works, because we don't know what's going to happen. So I wouldn't be pissed as long as I want to own the shares. Either I'm getting $600 or I'm getting the shares of Apple at 274, which is $7 below where it's trading right now. So that's one strategy that you can use if you're long-term investors. You can sell cover calls against the shares that you own, and you can sell naked puts against the shares that you actually want to buy. What if you don't have big amount of money and you still want to use these strategies, you can do something called leap contracts. You can buy leap contracts and you can sell weekly calls and monthly calls against it. So let me show you what I mean by that. So I'll change this to blast all. Is there a way to clear? Yep, I deleted all that. So let's say I think I want to make money, and what I want to do is I'm going to buy, I think by January, Apple is going to be worth more money or whatever. This is a directional bet. This is almost like, buying the shares even when you don't have the money for it. So what you can do is you can buy the $300 calls for January 2022. So this is giving you us like 2 years, almost like, well, a year and a half. Or we can actually do it just 1 year. Let's see, because 1 year is going to be cheaper. All right, so you can see that thing. Expectation by January is that the stock is going to be worth somewhere around $324. So I can buy one contract of that. And what I can do is I can sell monthly contracts against it, or weekly, depending on how you want to do it. But I can sell monthly contract against that. So I can sell, let's say, it's not showing me 300, but let's say I might be collecting what, close to $4 for that, and then I'll sell June contract. I can even go to the June contract directly. So if I sell June contract for 300, I'll collect $800 for that, and by that time, the price is not around $300, or even if it is, I can sell the next contract for the next month, where I'll collect more money. So you can see how there's a big difference between 300 over here is $8, and over here is close to like $11. So every month you're gonna be keep rolling it over and collecting that premium. So this is a cheaper way for you to really go in a big company that you want. And you can do like 1 year contract, you can do 2 year contract, and you can sell contracts against it just like you own the shares. And I used to do that thing a lot with defense stock, and they really did very well. I'm actually pissed I haven't done that thing in like last 3, 4 years, because I used to make a lot of money from those things, because defense stock like Lockheed Martin, Raytheon, or whatever, they always go up. But it does require a little bit of work. It does require for you to get used to it, because the price, if you're right, and if you're in a bull market, the price actually keep going up. So you always have to sell a little bit higher out of the money, because you're making money on your long contract, and you want to make sure you're giving yourself enough room that your short contract that you're selling is not going in the money, because most of the value you collect on the time is when they're out of the money. All right, so well, actually, I think I'll be going for too long. So I think I'm going to cut it off today, and we'll cover this day trading gap and go strategy and swing trading on how actually the big hedge funds and big funds really trade it, and how I actually use them, where you see a lot of them in the chat room. So I actually do a lot of work researching and everything to do all that. So for example, let me just show you quickly. We'll cover how to do all that. Um, this is so. For example, ZTO. Let me show you what I mean by that. Actually, let me pick a better. We could pick junk. So let me see what expiration. So I bought junk puts over here, and obviously I give my nice explanation for it and the reason why I'm seeing it, why I'm going in there. So it's $101 puts, and for May 15th. So I'll go to options over here. Wow, this thing's dropped nicely. Um, so you can see, let me see it right now. This thing was worth around $99. So you can see, well, actually, when I bought it, when I was doing it, it was worth around like 100 to 100 dollar and 71 cents to 101. So you can see even this contract right here, the bid and the ask. Oh, this is the wrong stock. Where's stock? Right here. And my prediction is puts. I'm expecting the price of this thing to really go down. And right now you can see this was on 416. That's about 10 days ago. And 10 days later, right now, is really down like $3, $4. So our put is actually working very well. And I'll show you why I would enter that. So I enter the put side. You look at the open interest on this thing on the call side. Not much. Now look at this thing on the put side. You see how many contracts are right there on the 1,000, on $102 puts, 101 puts, $98, $95, $85. So you can see this is a big directional bet because people are paying a lot of money to get into those contracts. And you can easily see this thing even at current price because we don't know what the price was when they bought it. Well, I know because I'm usually following it and going in based on that. I have a different software. I actually subscribe to. I pay like close to $1,200 a year for that. So it shows me all those big orders, and I do my own research on top of that. So 107 shares of that. Let's just say current price of $6. So right, oh, time 100 shares. Doing it correctly. So $6 time 107 contracts time 100 shares. Yeah. So somebody literally paid $604,000 for these contracts. It could be one guy, it could be a couple of multiple guys, but you can see somebody made a place a bet over $600,000. And obviously, one-on-one strike, that's even more contracts. So you can see that this bet is probably over $1 million. So somebody is making a clearly directional bet on these things, which are usually the big funds. They usually do a lot of research on them, or they may know something insider information or whatever it might be that may not be out to the public yet or whatever. Obviously, we don't trade, we don't have any public information, and this is as best it gets to us with the knowledge where the big guys are placing their bets based on whatever their research is or whatever the information they have, and we can make our own bet based on these trades, and we combine this with option flow, open interest, with the technical analysis, with the news and everything, and we get a very nice trade that we can actually take without having to do a lot of research and everything, where it doesn't cost us a lot of people and all these professional who are doing the research for like a couple of weeks, a couple of months on a certain companies and everything. So I provide all these information trades and everything based on the research I do, based on these trades I'm taking on my accounts. I giving you all access to all that. And as you can understand, I make it very simple. So it's either a call or it's a put, and I tell you which strike I'm buying it and which expiration I'm buying it. And so this way, if you like the trade idea, you can actually go in it, and you can also, you know, profit. And usually, a lot of these trades will turn up to be anywhere between 50% to 200% profit on most parts. So they do get very nice profit within the 30 to 60 days or whatever might be the expiration. And also remember, nothing is under 100%. So obviously, I think my win rate, if you just like go through the whole chat room on the alert or whatever, it's around like 70% or even higher or whatever. But if the trade is not working for you, if it loses more than 50% of the premium, it's just time to exit that trade. It's just time to cut your losses. You know. and just save that capital for the next trade. So you can see all these trades that I've been taking it, and I'm giving my explanation. I'm spending a lot of times as a part of the membership. You get access to all this, all my research, where you don't have to spend crazy amount of like $1,200 or more to get access to additional software, then do a lot of research on this thing to come up with that. Obviously, you can do all that if you're at that level where you have a big account and you want to make more money and you want to get more ideas. Then obviously you should be taking this step like I do, where spending some money or like and doing all this thing yourself. Yeah, obviously it does require time, it does require a little more capital, but the great thing, the benefit of this chart room is you're getting access to all this. Normally, I try to go ahead and give you 2 trade ideas a day when I'm trading it, when I'm adding more to my portfolio, one on the call side, one on the put side. So this way you nicely hedge on your portfolio. Personally, the way I like to do it is I'm close to 70% long and 30% short. In the recent market, I'm maybe close to 50-50. I'm like 50% long, 50% short, but I provide you enough ideas based on the option flow, based on my own trading experience. So this way you can take these trade ideas if you like it, and it giving you more trade ideas to trade based on, rather than just like don't know which one to really go. And I'm putting my own money on this trades. So this way you get a good idea that I'm just not giving you some bullshit trades. As you can see, always like, providing majority of the, I would say 80-90% of the time, I'm posting my screenshots and usually posting it right away. So you can see it's like 12:08 and it's not showing me the time right now, but I'm pretty sure within like 5 minutes or whatever, I'm posting it over here so everybody else, if somebody wants to follow the trade, they can actually get into it. All right, guys, so I'll provide more detail regarding these 2 strategies that we use for the intraday trading, gap and go strategy, and swing trades, how I actually get to these kind of trades ideas and everything, and how the big funds uses and how I track them. So we'll cover that in the next session.